Okay, good morning. So what we're going to be talking about today is recession, rates, and real estate, and how they are all intertwined. Looking back over history and looking at some key indicators that bring us into recession to try to figure out, when that's going to happen, and then, of course, most importantly, how to what to know to say to our buyers and our sellers when we're in that period of recession. So first of all, let's define what a recession is. So recession is defined as two consecutive quarters of gross GDP, gross domestic product, a reduction in gross domestic product. So what is GDP? That's the monetary value of all furnished goods and services produced within a country's borders. So televisions, refrigerators, shoes, clothes, everything. That's a country's total production. So if we have 2 quarters in a row of decline in gross domestic product, that's considered a recession. So, and there are some good indicators that we can look at to figure out when a recession is going to come or how close are we to a recession. So one of those that we're going to start off with is a great indicator, which is the 10-year Treasury minus the 2-year Treasury. So a little backdrop on these. So the 10-year Treasury is always higher than the 2-year Treasury. A long-term rate is always higher than a short-term rate. So, and let's talk about how rates move in relation to our economy. Then we'll take a close look at this chart. Okay, so low inflation is a symptom of a weaker economy. And when the economy is strong, prices move up, right? Because people are buying, whether it's cars, houses, or clothes. That's inflationary because people are buying. So as people are buying, price of goods are getting more expensive, which is inflationary. And inflation is the arch enemy of bonds. Because if an investor, if the economy is growing, investors want to be investing in the corporations because the corporations are doing well, which means they're not investing in bonds. So if they're not buying bonds, the price of bonds are falling, right? Just like if nobody wants to buy your house, the price is going to fall because nobody wants it. So bonds are the exact same way. If investors are buying stocks, then they're not buying bonds. So the price of bonds fall, which drives the interest rate up. They have an inverse relationship. When the economy is doing poorly and corporations aren't doing well, investors are buying bonds. Buy, which drives the price of bonds up. But that drives the interest rate down. So that's what happens. So that's the relationship between inflation and bonds. If there's inflation, that's the arch enemy of bonds. So bonds don't do well. The price doesn't do well during inflation. So let's look at this 10-year minus the 2-year and its relation to a recession. So if the 10-year is at 5% and the 2-year is at 2%, 5 minus 2 is 3. And that's what this chart is designating. So this is 0. So 5 minus 2 is 3. So right here we're at 2.5, right? The difference between the 10 and the 2, 2.5 and almost 3% here. So there was a 3% difference between the 10-year and the 2-year. So every time the 10-year drops to 0, meaning it's the exact same interest rate as the 2-year, or it falls below, this is called an inversion, we lead into a recession. Each one of these gray columns throughout all my slides, these are recessions. So recession, 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 recession. So 10-year falls below the 2-year, recession. Climbs above, falls below, recession. Climbs above, falls below, another recession. Here's the small anomaly, but that was a very short period of time. 10-year falls below the 2-year, recession. 10-year falls below the 2-year, recession. So that brings us all the way out to today. We've been in our strongest growth economy for the past 10 years. So right now, we're just above 0. Remember, this is the 0 line. So right now, there's a 15 basis points difference between the 10-year Treasury and the 2-year Treasury. 100 basis points equals 1% interest rate. So essentially, it's 15 cents on the dollar. So we're 15 cents, and once we drop below to 0 cents, then we can fall below. And we don't always have to be negative to run into a recession, but short-term and long-term interest rates are virtually identical. So That's one good indicator. Now let's look at an even better indicator, and that's the unemployment rate and recessions. So with 100% certainty over the past 65 years, this is 1950, so almost 70 years, with 100% certainty, the unemployment rate has predicted a recession. Now this is a very misunderstood chart. People think when unemployment's high, we're going to be in a recession, when in fact the opposite is true. When employment gets to its lowest point and then ticks up a little bit, a recession ensues. Unemployment's low, 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 ticks up a little bit, recession. Employment's low, ticks up a little bit, recession. Low, ticks up, recession. Every single time, right? Every single time we go into a recession, unemployment's low, ticks up, recession. Low, tick up, recession. So once again, bringing us to where we're at today. Unemployment's the lowest it's been since 1953 or 1954. So right now we're sitting at 3.7% unemployment. So what we want to watch is if that unemployment starts to tick up to 4%, 4.1, we can pretty much with 100% certainty guarantee a recession is going to follow 6 months later. So this is just, it's 100% accurate. So now let's look in relation to the 30-year fixed. So during a recession, what's happened to a 30-year fix? Remember, all the gray bars are recessions. So I highlighted what the rates did during the recessions, the last 5 recessions. So the most recent one, we entered at 6% and we came out at 4.875. Here we entered at 7 3/8 and we exited at 6 3/4. Here we entered at 11, exited at 8.75. And remember the 80s, we entered around 18%, we exited at 13%. And this last one, look how small this recession, how short this recession was, 6 months. We went from 16 to 11 3/4. So during times of recession, that 30-year interest rate is going to decrease. And that makes sense if we go back to that 10-year bond, right? The 10-year bond is less than the 2-year as we enter into a recession. So now let's take a peek at real estate. And the media is going to be talking, oh, we're in a recession, real estate's going to suffer. Well, let's take a look. The blue line is the Case-Shiller report, which is the gold standard for our housing index. And this is again going back 40 years to 1975. And each time we're in a recession, housing values actually do pretty well. Look at this read. We enter, exit, pricing values are up. Enter, exit, prices are up. Maybe kind of stable here, maybe stable here. Here, once again, values are up. Now, what gets misunderstood in this chart is the housing bubble. So the housing bubble led us into the recession. But if you actually look at the values didn't change all that much. We entered right here, and that's maybe 158,000 median price. And we exited right here, which is maybe 152 median price. So we actually didn't do too bad in the worst housing in the housing bubble, right, during the recession. Now, of course, we continued to decline afterwards. And why'd that happen? Well, remember back here, people were getting loans with 550 credit scores, 100% financing on an investment home. Today, you can't even get a loan with a 550 credit score. So all these loans, people were getting into them, driving the values up, and that's what drove the values up, was that all this financing was available. Then, when all those products that were all adjustable rate mortgages, when the rates started to climb and the payments started to climb, people couldn't afford the payments. And all of a sudden, they're like, uh-oh, I can't afford the payment, and they started not making payments. And then, of course, the market started to crash, right? So what took so long? So as we entered, remember the recession was maybe, I don't remember exactly, but 12 to 16 or 18 months. But the foreclosures continued to happen afterwards. Well, remember, when people stop making a payment here, it's at least 120 days before you get a foreclosure notice, then another 5 or 6 months before the foreclosure actually happens, then another 4 or 5 months before the bank actually gets it back on the market. So that was just a result of how long it was taking to get things back on the market, get them sold. Now, of course, from there, what did we do? Here was the peak out, and now we're actually higher. So 10 years later, we're actually higher than where we were at the crash. But this is based on supply and demand. These products don't exist anymore, right? The 550 credit score, 100% investment. So those products, so right now we're just in a supply and demand market. So the supply is low, the demand is strong, and that's going to continue to push the housing prices up. So why is this? Why does housing do fairly well during a recession? Well, you already know the answer to that. We talked about it, the 30-year fixed rate mortgage. So as the interest rates decline during those recessionary periods, that means that people can afford the homes because the payments staying the same or going lower, even though the values are going up. So that just helps with the housing market. So now let's see what the Fed's take is on all this. Now the Federal Reserve, amazingly, as educated as all these guys are, as far as I'm concerned, they've got beer goggles on. None of these guys, they're all super educated. They've gone to Harvard and law school, and they have all this financial education, but none of them have so much as run a lemonade stand. So what does that mean? I don't know. But here's our president, Jerome Powell. So let's take a peek at what they thought over the past few recessions. What was the probability of a recession 12 months ahead of the recession? So the Fed thought there was a 15% chance of a recession 12 months before this recession. And 12 months before this recession, they thought there was a 15% chance. While we were in the recession and almost exiting, they thought there was only a 45% chance we'd be in a recession. Now, in their defense, remember, we don't know we're in a recession until after gross domestic product. So it's a byproduct. It happens that we know we're nowhere in a recession after the fact. And then here, before the most recent recession, they thought there was a 25% probability we'd be into a recession. So now here we are in our strongest growth period, 10 years, and the Fed says there's a 33% chance of a recession in the next 12 months. Now, when exactly will that recession happen? We don't know. Let's watch those indicators, right? So now let's see where we go from here. And we still have a lot of room for rates to go lower. So this is where we're at today. So actually today we're at 2.05. So this is our 10-year bond, and this is all the government bonds, not all, but the ones I have here on the chart, and what they're offering for an interest rate. So right now we're paying 2.05. But look at all the way over here in Switzerland, a negative 0.5. Well, what's a negative mean? That means I invest in my Switzerland bond, I give them my money, I give the government my money, and I pay them 0.5% to hold my money. Well, why do investors want to do that when they can come over here to the United States and get 2% on their money? So that's one thing that's keeping the price of our bonds high and pushing interest rates low, is that these other economies are doing worse. So they're coming over here and buying our bonds. Now, that doesn't mean we don't have room to decline, right? So look at some of the other, look at the UK, they're 0.83%. So we definitely have room to still drop. So, and now let's look at what's happened over time with the forecast with interest rates over time. So again, this is the 10-year Treasury note. So our most recent cycle, so these are your cycles, your trough and your peak. So our most recent trough and peak, which is this right here, this is our trough, this is our peak. So our trough was 1.37. So that's this. Our peak was 3.24. And now we know that we're sitting at 2.05 right here today. Let's look over history. Every peak and every trough is lower than the previous peak or trough. This is about the exception to the rule. And again, we're going back 45, 50 years. We've got these two, they're about the same. Maybe this one's a tick higher. But then since then, every trough is lower, lower, lower than the previous trough. Every peak is lower, lower, lower than the previous peak. Previous peak, this peak is lower. Trough, lower. So now with our peak, where is our next trough? 1.37 was this trough. Going back to the previous slide, look at these, 0.83, 0.4, I don't know. That's where we're watching. So if we continue on this chart, our next trough is going to be below 1.37. And what's that mean? That means the 30-year fixed rate is going to be even lower. So, which is going to, be good for the housing value. So what do we look for? So let's watch these indicators. So what you can watch on a daily basis is the 10-year Treasury note. Remember, we're trading at 2.05. It's been really volatile. 2 weeks ago, it was at 1.9. So there's a big swing in this Treasury bond. So this is a daily indicator. And remember, we're watching that in relation to the 2-year. Then the other one we can watch with 100% certainty is unemployment, right? Right now we're sitting at 3.7%. If we start to see that tick up with 100% certainty over the last 65 years, a recession follows. And then the last one, which is going to be the larger indicator, is your GDP, gross domestic product. This is a quarterly figure, which is actually going to come out tomorrow. So these are your three things to watch. Unemployment rate ticking up, 10-year Treasury note dropping, what's our GDP? Remember, this is going to be a lagging indicator because we're not going to know we're in a recession until that happens. Okay, so that's it. If you have any questions, reach out to me. You got my number, you got my email. Happy to answer any of your questions. And Vince Mazzocco, your home mortgage consultant. Make it a great day.